Hi. Let's learn about the average annual return, AAR. The average annual return is a percentage used when reporting the historical return, such as the 3-, 5-, and 10-year average returns of a mutual fund. The average annual return is stated net of a fund's operating expense ratio. Additionally, it does not include sales charges, if applicable, or portfolio transaction brokerage commissions. In its simplest terms, the average annual return, AAR, measures the money made or lost by a mutual fund over a given period. When you are selecting a mutual fund, the average annual return is a helpful guide for measuring a fund's long-term performance. However, investors should also look at a fund's yearly performance to fully appreciate the consistency of its annual total returns. For example, a 5-year average annual return of 10% looks attractive. However, if the yearly returns were plus 40%, plus 30%, minus 10%, plus 5%, and minus 15%, performance over the past 3 years warrants examination of the fund's management and investment strategy. There are 3 components that contribute to the average annual return of an equity mutual fund: share price appreciation, capital gains, and dividends. Share price appreciation results from unrealized gains or losses in the underlying stocks held in a portfolio. As the share price of a stock fluctuates over a year, it proportionately contributes to or detracts from the AAR of the fund that maintains a holding in the issue. Capital gains distributions paid from a mutual fund result from the generation of income or sale of stocks from which a manager realizes a profit in a growth portfolio. Shareholders can opt to receive the distributions in cash or reinvest them in the fund. Capital gains are the realized portion of AAR. Quarterly dividends paid from company earnings contribute to a mutual fund's AAR and also reduce the value of a portfolio's net asset value. Like capital gains, dividend income received from the portfolio can be reinvested or taken in cash. Calculating an average annual return is much simpler than the average annual rate of return, which uses a geometric average instead of a regular mean. The formula is x, 1 plus r2, x, 1 plus r3, x, 1 plus r, 1/n, 1, where r is the annual rate of return and n is the number of years in the period. The average annual return is sometimes considered less useful for giving a picture of the performance of a fund because returns compound rather than combine. Here are 3 key takeaways. 1. The average annual return, AAR, is a percentage that represents a mutual fund's historical average return, usually stated over 3-, 5-, and 10 years. 2. Before making a mutual fund investment, investors frequently review a mutual fund's average annual return as a way to measure the fund's long-term performance. 3. The 3 components that contribute to the average annual return of a mutual fund are share price appreciation, capital gains, and dividends. Hope this would help. Thanks for watching.